This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The question Clooney. This was number 3 in the December 2010 P7 examination. First of all, let's see what it's about. And it says, requirement, comment on the matters you should consider and state the audit evidence you would expect to find in your review of the audit working papers for the year ended September 2010 in respect of a compensation claim, Shelly Cruises and the acquisition of Craig. So two elements in here, the matters we should consider and the audit evidence that should be there. Okay, it says that you would expect to find in your review of the audit working papers, and so rather than saying, go and inspect the board minutes, if that was relevant, you would say I would expect to see the following in the working papers, results of a review of the board minutes, which is, mentioning some of these issues. So it's the matters, the key matters, really, I should think, and the audit evidence. There's 20 marks, they're not all the same. Obviously, the compensation claim is going to be slightly more complicated, or so certainly more to say there than there is in this acquisition of Craig. Okay, let's see what the question says. It's one of the world's leading leisure and travel providers, operating under several brand names to send package holidays. Catered for more than 10 million customers in the last 12 months, so it's obviously large. Draft figures for the year ended 30th September 2010 show revenue of 3,200, profit before tax 150 million, and total assets 4.1. Now this is important. The reason that you've been given those three measures from the draft financial statements is so that you can assess the materiality of events or information that you're given afterwards. People do it in different ways. What I tend to do is I go in and I calculate my materiality levels immediately, because I'm going to need to keep applying those, and I'll write them down. So look at revenue. The standard materiality range is 0.5 to 1%. So we're looking there at 16 to 32 million for the revenue. When you look at profit before tax, the standard range is 5 to 10%. So the 10% is 15. So we're looking at about 7.5 to 15. And that's for the profit. And finally, for the total assets, 4,100. The range you should know there is 1 to 2%. So we're dealing in there with 41 to 82 for the total assets. I will keep referring back there to see whether any of these issues, if you like, are material, or whether there's something that we can say this is essentially pretty immaterial. We don't need to worry too much about it. So the first one is a compensation claim. I hope the question deals kind of paragraphs for each of these rather than mixing it up. And generally they do. They tend to say, one paragraph's all to do with issue number 1, and second paragraph all to do with issue B, and so on. So let's have a look at this. In July 2010, thousands of holiday makers will have stranded when the main airline used by Clooney went into liquidation. Holiday makers were forced to wait an average of 2 weeks before they could be rescued. They had formed a group which was claiming compensation for the time they were forced to spend abroad, with a total claim of 20 million. I think you can see there that 20 million is certainly very material with regard to the profit there, even with regard to the revenue that is material. So this is something we have to take seriously. The items for which the group is claiming compensation include accommodation and subsistence costs, lost income and distress caused by the situation. The claim has not yet been recognised or disclosed in the draft financial statements, as management argues that the full amount payable will be covered by Clooney's insurance. So they're saying, okay, we may have to pay out 20 million, but there's 20 million coming in and it'll just cancel out. Now, I think the first issue we have to really address here is basically one of offset. It is one of the principles of producing financial statements that you do not offset or net off assets and liabilities or income and expense. So this argument that it will be covered by insurance income effectively coming in, insurance compensation coming in, is going nowhere. It is simply not allowed to do this offset or netting. So we'd have to think about showing the claim maybe as income, an expense and a liability, or in some other way. Now really the heart of the matter here is contingent liability. For the compensation and a contingent asset really for the insurance claim. And what we have to find out is how likely it is that they're going to have to pay 20 million. And we probably need legal advice for that. If it's probable that they're going to have to pay 20 million, then we would recognise it as a proper hard liability in the financial statements. If it's only possible, then we would note it in the notes to the financial statements. If it's virtually certain that we're going to get the insurance claim coming in, it will be regarded as an asset. If it's only probable that we're going to get the insurance claim coming in, then it would only be appearing in the notes to the financial statements. So there's this, that's the main issue, how to treat these potentially contingent amounts. I think the second issue is have they got to, or how our litigants, our customers, how they got to 20 million. It might well be that we're almost certainly going to have to pay compensation, but maybe it'll only be 10 million, 5 million. So we need evidence of the kind of status of the claim, the state of the insurance claim, and also for the quantity which we have to be looking at. And remember what we said, you need evidence neat for the amount and the treatment. So we need evidence for the 20 million and the insurance claim, and we need evidence that they've been treated correctly. So what would we have hoped to have discovered in the working papers? Well, you would hope that we had looked at, or our staff had looked at, correspondence with this pressure group, and presumably with their lawyers, that the potential liability actually exists. We would expect to see some sort of schedule which is justifying 20 million. And we would expect the company or our staff to have done some sort of auditing of that schedule to see whether it's outrageously high, even we did think we were liable for it, or whether it's too low, or whether it's about right, and so on. So we need to, I think, look at the kind of reperformance of some of the calculation. If people were claiming for loss of work income because they were stranded for 2 weeks, we'd expect that to be backed up by some sort of maybe letter from their employers or something of that type. We would expect this large argument to be discussed at board level. We would have expected the board to have taken legal advice, and the legal advice would be telling them whether 20 million seemed to be about right, and also how likely it was they're going to have to pay it, whether it's probable or whether it's merely possible, or whether in fact it's extremely remote, because if it was extremely remote that 20 million was going to be successfully claimed, we wouldn't mention it at all in the financial statements. On the other side, we would want to have inspected the insurance claim to see, not the insurance claim, but certainly the insurance policy, to see the sort of things that it actually covered. It may well not have covered these kind of consequential effects that people have been suffering from losing money at work and so on because they've been away for 2 weeks. We would hope that the company had told its insurance company, because generally speaking you're supposed to alert your insurance companies as soon as even as a risk of a claim, and we would have hoped that our audit staff would have looked at kind of correspondence with the insurance company and to get some feel about whether the insurance company was likely to be able to kind of pay that or not. And maybe we would then say, if the directors are convinced that the financial statements shouldn't be showing these amounts, and of course we're not at all convinced that that is the case, but if the directors were convinced as maybe the claim is not valid at all, that it is extremely remote, that it is going to be paid to these travellers, then we would expect it to be in a letter of representation as well. What about Shelly's Cruises here, the second one that we've got here? One part of the activity is operating under Shelly's Cruises brand, provides cruise holidays. Due to the economic recession, the revenue of these cruise business has fallen by 25% this year, and the profit before tax has fallen 35%. And they contributed 640 million to total revenue. So if we look up here at 640 million to total revenue, it's within this is 16 to 32 million. Yes, gosh, that is very material indeed. Here, this is coming into about 20% of revenue, so it's a heck of a bit of the company. And also the identifiable assets here, 235 million, way above even the upper limit there on the total assets. So this is certainly a material part of the business. Shelly's Cruises brand has not recognized, or is not recognized as an intangible asset, as it has been internally generated. So that's good. We don't have any bother with the valuation of intangible assets and whether that requires some sort of impairment. But what we might have bother with is if we have this huge decrease in revenue and profit. What happens if it decreases the next year and the next year? Then we ought to be worrying about the presentation of the non-current assets. They're presumably in the statement of financial position at cost less depreciation, but we should really be thinking of impairment of the non-current assets, because if they're not going to be generating any substantial income or profits in the future, there's no income really coming from use, or very low income coming from use, then we ought to be writing it down. What should we be looking at? Well, presumably we would want to first of all see the figure that they're starting with in the financial statements is correct. So we go to the statement of financial position, see the net value of these cruise liners, and we want to make sure they put through the normal depreciation charge. We would look at the change in the cost, add your acquisitions, take out the assets disposed of, we'd compare it to last year's and so on. We'd make sure that at least the net book value, if you like, of the cruise liners was okay. And then what we would expect is management to have carried out an impairment review to see whether or not they should be writing down the value of these liners. What we should be doing is kind of picking away at that. The sort of evidence management will be presenting that these don't need to be impaired is maybe saying, right, it's decreased 25%, but these cruise liners are going to be around for the next 10 years. We don't expect the revenue to be going down. We might be looking at or evidence of early bookings for next year. This might have been a temporary blip. We don't know. It might have been a quick recession, or maybe some sort of, travel terrorist related attack, frightened people for a year, but then we expect it to bounce back next year. But if we see it's kind of going down, if we we see evidence that they have mothballed some of these ships, that they're permanently moored somewhere, because we can't get enough people to go on them, then this is certainly evidence that the impairment isn't needed. So we can also ask management, are you still using all of the ships? Could we see the schedules for the ports and the trips they're going on for the next year, so we can see they're all still in use? We'd be interested maybe in the sales value of the ships, because remember, you should write down these assets to the higher of the value through use and the net realizable value. And if it had very little value through use, nevertheless the net realizable value might be higher, and that's really the fair value that the ships should be displayed at in the statement of financial position. Maybe look at advertising, maybe talk to the managed marketing people and so on to see whether or not they've got great hopes for next year and so on. Again, review board minutes. If, this huge element of your operations seems to be hitting the buffers, again, you'd expect board minutes to be discussing this item of high worry. And if more or less the board had agreed that the popularity of cruises was down and permanently down, then this may well be at odds with what we've seen in the impairment review from the directors. And finally, we'd expect to see this mentioned in the letter of representation as well, that the board of directors feel that no assets need to be written down because of impairment to some other value than net book value. And finally, we've got here this business of the acquisition of Craig. We're given no information about its size in this one here, but it has acquired Craig, a company offering adventure holidays for independent travellers. Although it does tell us it represents a significant acquisition. We look at the date, 15th of November 2010. We're doing the audit of September 2010. So this is an event which is happening after the period end. And therefore, it is a non-adjusting event. You'd certainly never think of bringing this in to the financial statements. However, it would be expected that a major acquisition happening shortly after year end and before the audit report was signed or the accounts were approved, you'd expect this to be mentioned by way of note to the financial statements. It is reasonable that the financial statements tell the shareholders, by the way, we're kind of acquired this, maybe we're branching out slightly into something which is different. If we're going to be happy with this being noted in the notes to the financial statement, then remember you need evidence for that as well. So you need evidence for the amount and the treatment. So even though the amount isn't appearing in the statement of financial position or the statement of profit or loss, nevertheless, in the notes, the existence of the acquisition is there. We need evidence for that. So we'll be looking at, no doubt, share transfer documents. We'll be looking maybe at the payment going out around the end of November. We'll be looking at the contract of sale and so on. We want evidence they have actually acquired Craig, and we want evidence about the amount which they have spent on it, because presumably this is going to have to be divulged in the notes. So just because something's in the notes to the financial statements doesn't mean that we can go easy on the evidence. We need evidence as what saying in the financial statements is right, and the whole note is correct. Otherwise, the financial statements will not be showing a true and fair view.